Welcome into Your Course to Retirement. We have with us, as always, founder of Cornerstone Retirement Partners. He is Ron Corser, CFP. Ron, we are quickly approaching the end of the year. It's really time to start wrapping things up and thinking about what we can do for next year.
Yeah, thank you, Peter. Welcome to everybody to today's program. I'm Ron Corser with Cornerstone Retirement Partners. This program is going to deal with a couple of interesting things. And if it touches a hot button with you, you can always reach out to me or our team at Cornerstone Retirement Partners. You can go to the website, www.cornerstone-rp.com. That's www.cornerstone-rp.com. You can tune into today's program or other programs that we've had. A lot of good information on that. Or you can actually reach out and call us at 616-301-2581. That's 616-301-2581. We'll reach out to you. Let us know how we can be of help to you. So let's go forward today. Here we're coming up to the Thanksgiving season. Believe it or not, I think there's a lot to be thankful for in this country. Yes, if we think of this country as our family, it's like a lot of families, isn't it? There's some crazy uncles and aunts there, and there's some people that seem to be a little more rational, but they're our family. So on Thanksgiving, we put up with all of them and love all of them. So here coming into Thanksgiving, what do we have? Number one, we have that interesting thing called Black Friday. And it's not what it really used to be, because the internet and all these other companies have started to do with Black Friday on the internet starting at 2 and 3 weeks beforehand. But people still do seem to want to line up at 3 o'clock in the morning to go fight for a 60-inch TV or some kind of doll or something like that. And in many ways, anticipating and lining up for what they think is a good deal seems to be worth it. A lot of that same mentality exists when it comes to our investment strategy. We sit and we think, okay, how can I make some money on my investments? Because I need my investment portfolio to grow over time. So I will eagerly anticipate good things happening. If I just do a hard thing, if my advisor, Ron Corser, just picks the right stuff, if we get in the market at the right time and we get out at the right time, everything's going to be just fine. That's a good way to approach the world. It's probably not entirely rational, but as human beings, we're not entirely rational, and that's what makes us so interesting. So here's what I tell folks when it comes to investing in a market, and we're going to talk about it. There's a lot of things that go into creating an income plan in retirement, creating an investment plan that'll support that, creating a plan that will stand up to the market's ups and downs, the volatility, the uncertainty. There's a lot that goes into that, and there's a lot of required ongoing kind of looking over the portfolio all the time to make sure we're properly positioned. And we're going to talk about a couple things today. We're going to talk about the impact of higher interest rates or lower interest rates on our portfolio and what it means to us, because it's really important. Interest rates have had a dramatic effect on all of us over the last 2 years. And then I'm going to touch a little bit on something that is of interest, and that's something that Dave Ramsey said a while back. And so we'll talk about that a little bit too. So let's focus on what does higher interest rates or lower interest, what do interest rates mean to us as investors? Interest rates are really, really important. And the simplest form of why they're important is that, think of this, think of the interest rate on a 10-year Treasury bond. That's the interest rate free number. That's the free rate of return, if you will. So stock market rates of return or prices are based on that market free risk versus what kind of return we could have. So when interest rates go up on the 10-year Treasury bond, it puts a lot of pressure on the stock market, because that means stock prices have to go up. Well, stock prices don't always go up when interest rates go up. In fact, it could be just the opposite. So one of the most important things to understand of why interest rates are so important is that they have an impact on the long-term rate of return on the stocks in the stock market. If interest rates go up, it becomes more and more difficult for stock prices to continue to go up at a rate which more than compensates for that interest rate or inflation. So that's one of the things to keep in mind and why it's important. For savers, higher interest rates can seem to be a good thing. What do I mean by that? We've all experienced over the past 9 months that your basic CD rates in banks have gone up. They've gone up from 2% to as high as 5.5% for a CD. And so a lot of people, a lot of clients were putting them in CDs for two reasons. Number one, it's been such a long time since we've had this. It's almost like the good old days. And people are comfortable with CDs. And we're comfortable as an advisor to say, yeah, let's put some of that cash to work in a CD. Now, will it stay ahead of inflation? Well, it depends on where inflation goes, right? So if you're getting 5.5 on a CD right now, that's what the official inflation rate is. We all know though, don't we? You know, that maybe not as accurate. One of the things that I joke with people sometimes, I say, always remember the 11th commandment. And they say, what is the 11th commandment? The 11th commandment is, thou shalt not let thyself be buffaloed. I'm going to repeat that. Thou shalt not let thyself be buffaloed. The government says we have interest rates about 5.5. All we have to do is go put some gas in our car, go to the grocery store, take a look at our gas bill for the house, the electric bill, to know that probably that's not exactly accurate, and it's probably well understated. So don't be buffalo about that. Inflation is much higher than the government's telling us, and we know that. So, but we can play along at least and say, okay, I'm going to put some money in a CD because interest rates are going up. Now, it's important. What I tell our clients is that if we're going to invest in CDs, keep the rate, the time that you have a CD short, meaning do 6 months up to 9 months. That's what we're recommending. Why? Because we think rates are going to go higher. And remember when the good old days when we used to kind of ladder the CDs. My mom used to do that all the time. She was a great CD investor. She'd get a 3-month, a 6-month, a 1 year, maybe up to 2 years, depending on what was going on in interest rates. And also, was she going to get a free toaster or waffle iron or some kind of appliance? But she would kind of ratchet those things up over time, and she would ladder them. And so we say to people, ladder them too, because remember, in the beginning of the year, interest rates on CDs were like 3.5. Now they're up to 5.5. And if interest rates keep going up, rates on the CDs will continue to go up too. So that's one of the impacts they'll have for savers. Now, what does it mean for the bond market? What does it mean for the stock market? If interest rates continue to go up, remember in the beginning of the program, I talked about what's their free rate of return. That's whatever the interest rate is on a 10-year bond. So if interest rates continue to go up, it's going to really have potentially a negative impact on the long-term direction of the stock market. I'm not saying the stock market can't go up in that environment, because we've already seen that it has done it on some short-term time here in the last 6 months. I'm just saying that over time, as interest rates go up, it becomes more and more difficult for the stock market to continue go up. So one of the things you have to be aware of in developing a portfolio or doing reviews, especially if you're our clients, and we do this all the time, is take a look at where you are, what kind of things you're invested in, and say, well, what do I think might happen if interest rates continue to go up? What will be the impact on interest rates on what I'm invested in right now? It's a really key question to ask. So far, if I've touched on some things that you have an interest in learning more about, or you want to address in your own portfolio, such as volatility risk, what's the impact of interest rates on what you're invested in, give us a call here. Again, I'm Ron Corser with Cornerstone Retirement Partners, 616-301-2581. That's 616-301-2581. Or go to our website, www.cornerstone-rp.com. Put your information in there and we'll reach out to you. You can also see today's program and the other programs we've done over the past couple of years. Has a lot of great information. You can learn a lot of good stuff. So again, it's www.cornerstone-not_but-.com. www.cornerstone-rp.com. Sometimes I don't remember my own home phone number. So what about What does this do if you're trying to build a portfolio because you need retirement income? You need your life savings to generate income for you. What does higher interest rates mean? What do lower interest rates mean? Well, think about this. We've already talked about higher interest rates are good for CD kinds of things. Higher interest rates are not so good long term if they keep going up for stock market stuff, potentially. So, in thinking about how to create a retirement portfolio, if you need income, you have to take a look at how much income will each and individual security, whatever you have in your portfolio, whether it's stocks, bonds, or annuities, cash, what is it they're going to generate in terms of monthly cash? And then figure out, does it make sense to continue to hold that stock or bond? Or should we make a change? Should we change to something that will give us more monthly income? But then you have to think about, well, how much more risk am I taking on, or am I going to have less risk? So it's not enough for me to say, well, go do this and you're going to be fine. That simply isn't a good strategy. But it's something we can help you with in creating a portfolio that'll do a couple things. Number one, protect you as much as possible from really high volatility, the ups and downs in the market. Number two, to give you as much cash that you can get on a monthly basis without exposing your life savings to harm, what I think is harmful, high market risk, but to give you enough money coming in so no matter how volatile the market is, you can say, you know what, I'm going to have that income coming in every month. I'm not going to have to worry about it because Ron Corser, Cornerstone Retirement Partners, has structured my portfolio in such a way that the income is going to not be impacted by whatever happens in the market. We can help you do that. So if this is important, again, I'm Ron Corser with Cornerstone Retirement Partners. Give us a call at 616-301-2581. 616-301-2581, or go to our website, www.cornerstone-rp.com. www.cornerstone-rp.com. Put your information in there. We'll reach out to you and give you the information you need to make really good decisions for you and your family going forward. So let's go to another interesting topic. Okay, I've saved all this money all my life. Now I have to figure out how much money to take out of it on an annual basis because now I'm not working. I need to know how much I can safely take out of my life savings so that I don't run out of money or have to make a downward adjustment in my lifestyle going forward. And I want to talk about an interesting YouTube article, and I'm going to refer you to it right now. It's by Dave Ramsey. If you want to catch it on YouTube, just go to Dave Ramsey talking about withdrawal rates. You can just kind of put that in a Google thing and it'll come out. So one of the things that Dave talks about, and interestingly, he gets kind of aggressive with the words he uses. He calls it stupid and things like that, which I guess you can use those words if you're Dave Ramsey. But it's his position that the markets go up, and they have over the last 50 or 70 years, 12% annually. And he says that at 12% annually, if you're invested in the stock market, you can safely take out 8% to live on, 4% for inflation. You're going to be fine. And he gets into a pretty good discussion with his daughter on this. And finally, he just kind of overwhelms her and she backs off because she questions that withdrawal rate. And he has, he's pretty clear. He has no problems with suggesting to everybody you should be able to take out at least 8% annually of your money because the market always goes up 12%. Now, I got two ways to approach this. Number one, if we go back over the last 22 to 24 years, just take a look at the S&P 500. It has not gone up 12% a year. It hasn't done that. There's been a couple of years where it's gone over that. But over the last 22 to 24 years, it simply hasn't done that. Dave Ramsey goes back 50 some years and says the market's gone up 12% annually. So I don't know of anybody that lives 51 years in retirement, frankly. And also, here's the other part that I think he misses. Now, I'm not saying Dave Ramsey is a terrible person and whatever advice he gives you is wrong, because he does say some things that make good sense, particularly on how to handle debt and how to save money. I mean, it's good advice. But I think when it comes to this issue of taking money out of a retirement plan, I think he's really off base. Why? Because there's a lot of information out there. There's a lot of real information. Just going back to what I said, just go back over the last 22 to 24 years and look at the raw rate of return for the S&P 500. It is not close to 12%. So if you follow his advice, just invest in an S&P 500, let it rip. If you did that over the last 22 years, you have not done as well as he says you should have or would have. He's been wrong on that. Factually, statistically, realistically, and I guess existentially too. So I've made a kind of interesting statement saying that what he's told you is not accurate. And I will stand by that. And I can show you proof of that. So if you want to see the actual numbers, give us a call at 616-301-2581. That's 616-301-2581. Ask for the information on the stock market over the last 22, 24 years. I'll send you that information. You can see for yourself what the real numbers are and make a decision on that. Now, the second part of this rate of return and this withdrawal rate that's important is it totally ignores something called sequence risk. This is deadly to ignore that. This is really profound in that what is sequence risk? Sequence risk is the risk of having a loss in your life savings 2 to 3 or 2 to 3 years or so afterward before retirement. There's kind of a red zone there, 3 years before, 3 or 4 years after. And it says if you take a loss, then think about this. Let's pretend you have $1 million in your portfolio. You've done well, right? And you're going to take 8% out of that $1 million because Ramsey says it goes up 12%. So in the first 2-3 years, you have $1 million, you take out 8% that first year, and that's $80,000. But the market didn't go up 8%. The market actually didn't do anything. It just went flat that first year. So instead of having more than $1 million, now you have $1 million minus 80,000. So now stick with me. Now you have 920,000. You take out another 80,000 and the market goes down 10%. Not only have you taken out 160,000 over the last 2 years, but you've had a 10% loss in year 2. That is sequence risk. It's the risk of losing money in the first couple of years before or right after retirement. At this rate of return, if you keep taking out 8%, mathematically, statistically, because the markets don't go up 12% every year, you will run out of money if you keep doing this. Now, nobody ever runs out of money because what they do is they pull back on their lifestyle. So if you would like to see 2 things, number one, what the S&P 500 has done over the last 20, 25 years, I'll send you that information, or the impact of something called sequence risk on your life savings. Give me a call at 616-301-2581 here at Cornerstone Retirement Partners, or go to our website, www.cornerstone-rp.com. Put your information in there and we'll send you or talk to you about this information. Ladies and gentlemen, it is critical that you understand rate of return in reality, in real life, of the S&P 500 and the impact of potential market losses early on in your retirement plan. Absolutely critical. And we can help you through that. So if we've touched on something that kind of hit a hot button for you, give me a call. I'm Ron Corser with Cornerstone Retirement Partners. Our phone number is 616-301-2581, or go to our website, for today's program, www.cornerstone-rp.com. Put your information in there. We'll reach out to you. I'll send you those 2 pieces of information. If you have never heard about it or you want to see it, I tell you this, if you take a hard look at it and just look at it as factual, because it will be factual, it can change how you look at interest rates. It'll change how you look at how we're supposed to invest in volatile times. It'll change on how what you look at in terms of risk. So give us a call. Again, I'm Ron Corser at Cornerstone Retirement Partners, 616-301-2581. I want to thank you for listening to today's program. Have a blessed Thanksgiving, and we'll talk to you soon.
Tune into Cornerstone Retirement Partners' full radio program, Your Course to Retirement. Visit cornerstone-rp.com for many valuable resources, including those mentioned on this show and other great episodes of Your Course to Retirement.
The content of this radio show is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. You are encouraged to seek investment, tax, or legal advice from an independent professional advisor.
Ed Slott's Elite IRA Advisor Group is solely an indication that the financial advisor has attended training provided by Ed Slott and Company, passed biannual examinations on material covered at conferences and in webinars, and met other membership requirements, and does not constitute an endorsement of any kind. Ed Slott's Elite IRA Advisor Group members pay a fee for the educational programs that allow them to be included in the Ed Slott's Elite IRA Advisor Group. Membership does not guarantee investment success. Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services.
Advisory services offered through Brookstone Capital Management, a registered investment advisor.
Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.
Any investments and/or investment strategies mentioned involve risk, including the possible loss of principal. Any comments regarding safe and secure investments and guaranteed income streams refer only to fixed insurance products. They do not refer in any way to securities or investment advisory products. Annuity guarantees are based solely on the financial strength and claims-paying ability of the issuing company. Withdrawals of growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs. Early withdrawals may subject the owner to penalties, fees, or taxes.